Alright, we got a little bit of earnings content here. That is right. Nike here reporting earnings. They have obviously a weird little earnings period here as far as when they report usually. So, weird time compared to other companies really. But that's right, we got them. After hours down 4%. Not anything unexpected. It is kind of weird looking at the stock year to date. It's a clothing stock. Nearly flat on the year. It'll be down quite a bit on the year after, down around 4% on the year after this after hours decrease. But when you see other real clothing retailers, these are stocks that have been hit still 30 to 40% down on the year. And Nike pretty much has scathed all the way through. So I do think it'll open down tomorrow. Or really, I guess the morning that this is posted. I do think it'll stay down, and I think it probably deserves to be. Obviously, a company that's pretty resilient because of the client base, but just I don't know how the stock has any chance of being flat on the year. I just don't even understand that at all. And I think you'll understand my sentiment in that. When you see that they posted a GAAP EPS number of negative 51 cents, missed by 54 cents, and revenue of $6.31 billion, down 38% year over year, missed by $1 billion. So, based off those numbers, you're telling me that off of a 40% decrease in revenue this quarter, that you're seeing the stock go flat. That is what I find absolutely insane. I find that incredible. First off, it's a horrible miss. I didn't expect a profitable quarter. I know that there were estimates for it. I certainly did not expect a profitable quarter for this company. Negative 51 cents, all things considered, could be a lot worse. I got to be honest, it could be a lot worse. So it's not the end of the world, but that revenue decline of nearly 40% it's a rough one. I got to be honest. I don't know how the stock's staying at the levels it's staying at. I just don't know if I understand it. I don't necessarily get it. So Nike reports results were significant impacted by the closing of stores. Revenue fell 46% for the North America business. Gosh. While revenue in Europe, Middle East, and Africa, EMEA, as they sometimes shorten it to, was down 46% as well. Greater China revenue was off only 3%, and I think a lot of that's because you saw the virus hit them a lot sooner, so therefore they were opening up a lot sooner, so boom, back to more of normal. Digital sales rose 75% during the quarter, which they say is an offset, but it's not nearly the offset of, losing billions of dollars in revenue. So, all things considered, good to see digital sales increase, and my concern with a company like Nike again was going to be how do they transfer that normal customer base onto the .com sphere, right? These you see other retailers like Target growing their online business 200+% in a month. How does Nike do that? And clearly they weren't able to do such a thing, which I think is obviously where you see this hit. And overall demand for clothing was low. I gotta be fair. Target obviously carries everything. And demand for clothing has been down. Overall apparel sales have been just abysmal this year so far. So can't blame them too much, but you would have liked to see a little bit better of an increase in terms of digital sales. Because really it's more beneficial for the future the sooner they get those people buying digitally, so that way they can benefit from both in-store and digital. Gross margin of 37.3%. Factoring in a lower margin rate was higher. Product cost, including factory cancellation charges, increased inventory, obsolescence reserves, and adverse rate impact of supply chain fixed costs of lower wholesale shipments, primarily due to the virus. So this does bring up a good factor that I did want to mention here. As far as this obsolescence is concerned, if you know anything about retail, you know they're usually going to be playing their cards about 3 to 4 months ahead of the current season that's coming up. So your short sleeve items are going to start coming in February. It may seem weird, but you're not going to be getting winter clothing items in February. You just aren't. And at this point, if they haven't been able to send out their short sleeve items and they're not able to until June, they're already too late. This is kind of, which seems weird. July is the time in which you're going to see a lot of clothing retailers get sent in and they will be putting out long sleeve again. It's weird being in the dead of the season, but it's just natural, right? It's obsolescence. Why would you buy a bunch of clothing at full cost when you know they're not going to be sold in a month whenever it starts to change seasons? It doesn't make sense, because then you're going to have to mark it down and take a big hit. And that's why all of these retailers purchase clothing several months in advance, right? So don't be shocked when you see short sleeves in February. It's just planning for the next season. They don't want to have markdowns on those clothing items if they're paying wholesale cost. They don't want to do that. Nike says approximately 90% of Nike-owned stores are now open across the globe. Retail traffic continues to improve week over week with higher conversion rates as compared to the prior year. As physical retail reopens, Nike's strong digital trend continues, a testament to the strength of our brand and investments we've made to elevate digital consumer experiences. Good for them. Good for you trying that. Regardless, off a 52-week trading range of $60 to up highs of $105.62, the fact that this is close to the 52-week high is just disturbing, right? I don't understand how the stock can be warranted at that price. So I certainly say, just off pricing alone, I would ditch this stock. Do not buy it. I don't necessarily say sell it, but this is not a good level to buy it at, I'll tell you that. As we look at some of the fine details here, obviously good stuff here. They clearly talked about Nike-owned stores, not a shocker. Digital sales increase, we saw that, nothing crazy. As far as operations, 100% of Nike-owned stores in China are open, 90% elsewhere. So pretty exciting. Awful revenue, we know that. Selling and administrative expenses decreased 6%. It is good to see that. But again, it's because they weren't selling the product, so that's why you see that number decrease, which includes an incremental $178 million increase in bad debt expense. Demand creation expense was $823 million. You should expect to see these cost things really kind of decrease. If you're seeing a decrease in sales 40%, you're really hoping all production costs, stuff like that, decreases as well, but you never know. Effective tax rate was 1.7%. compared to 20.4% in the same period. Now, how they possibly muster 1.7% tax rate, I don't know, and I would like to partake in that. I'm busy getting taxed 30% out here, so if I could partake in that, I wouldn't be upset. But this is primarily due to a mix of earnings taxed in the U.S. and favorably attributed to items such as the use of foreign tax credits. I don't know. Net loss was $790 million. Definitely ugly numbers. You don't like to see it. Overall, for the full year, fiscal or revenue fell 4%. I can't say that's bad. If you're talking about full year, the fact that full year only sold or only missed by 4%, really off of just a disastrous quarter where they missed by down 40%. If you look at that, you say that's pretty interesting actually, because regardless, before this they were having quite the good year. So the demand definitely is high there. The demand is high, so I'm interested to see what exactly that leads to in the future. But that's good numbers there. Good numbers, baby. So I'm hoping they got a nice little balance sheet listed for me. They've done a great thing for me year over year, and they even gave a percentage change. Nike, you're treating me nice. Cash and cash equivalents on this company right now of, that's right, $8.3 billion versus $4.4 billion, 87% increase year over year. Now, one thing you need to mention, you're going to see a rise in assets, but what you've been seeing with these companies is they are taking on debt to take their current cash on hands increase quite a bit. They want more cash for the current environment because they usually need it for certain expenses. So they're raising debt, so you would expect to see debt increase by the same amount. Let's take a look. Total current assets, 20 million or 20 billion versus 16 billion, 24% increase. Total assets in general of 31 billion versus 23 billion, which is a 32% increase. Not bad. Liabilities, here you go. Definitely not quite as bad as you might think. Kind of. So total current liabilities went up 5% to 8.2 billion, but long-term debt rose 172%, or the equivalent of right around $6 billion, right around $6 billion. When you see they rose their cash level right around $4 billion. So all things considered, they rose debt more than they rose cash on hands technically, but that's not the end of the world. Shareholder equity of $8 billion still on this company. Definitely saw an 11% decrease, but it's not that bad all things considered. Could be a lot worse. So really, overall, I would say definitely an improvement. Not as bad as some of these other retailers have been seeing, especially clothing, but I just don't get. I can't understand the valuation for this stock right now. I just really don't understand how anyone is potentially even justifying the levels this stock's at. It can't be trading near 52-week highs. It just can't. Every other stock is trading at 52-week lows or near 52-week lows, and this stock is trading at 52-week highs. I just don't see it. I don't see it, boys. I'm not going to be buying in on this one. Really good company. Just don't want to buy in at these levels.